At 8:30 a.m. Eastern on March 6, 2026, the Bureau of Labor Statistics released the February Employment Situation Report, sparking an immediate reaction across global data terminals. The report showed a loss of 92,000 jobs in February. Mainstream consensus had anticipated a gain of 50,000, a miss of 142,000 positions that represents the worst monthly contraction since 2020. Simultaneously, WTI crude oil rose more than 6% following the closure of the Strait of Hormuz, reaching a 13.5-month high. These energy costs hit the market in the same week as the new 15% global tariff, which is already seeing price pass-through in 3/4 of Federal Reserve districts. When the labor market contracts at the same time energy and goods prices spike, the economy enters a stagflationary environment. The Federal Reserve now faces a direct conflict between its dual mandates of price stability and maximum employment. Cutting interest rates to address the 92,000 lost jobs would likely accelerate the inflation being driven by the Iran war and global trade barriers. Conversely, holding rates high to contain that inflation prolongs the debt servicing costs that are actively reducing payrolls. This environment renders the standard recessionary playbook ineffective. The central bank cannot prioritize one side of the mandate without worsening the other. The Economic Fragility Monitor currently reports a weighted fragility score of 42.1. This 42.1 reading classifies the current status as pre-systemic, a designation that remains formally unchanged from the prior release. This creates a gap between the headline data, the worst jobs report in 6 years, and the formal risk score. The framework relies on mechanical data thresholds rather than shifting with the narrative. This prevents editorial bias from influencing the systemic risk assessment. While the headline score is static today, the individual indicators are moving toward the thresholds that trigger a formal reclassification. The current threat level is driven by 3 specific indicators: unemployment, the Fed funds rate, and credit spreads. EFI 6, tracking unemployment, has risen to 4.4%. It is currently green, but we've issued an amber watch notation because it's trending toward the 5% threshold. This 4.4% reading also places the economy near a Sahm Rule trigger. The Sahm Rule is a recession indicator that signals a downturn when the 3-month average unemployment rate rises 0.5 percentage points above its 12-month low, which would be 4.5%. EFI 8, the Fed funds rate, is locked in the red zone. This acts as the structural lock on the system. High rates are required to combat tariff and energy inflation, preventing the Fed from easing policy to support the labor market. Credit spreads, recorded as EFI 1, have moved to amber at 3.03%. Credit markets are now pricing in an energy shock and a recession signal simultaneously, a combination that historically prevents spread compression. The interaction of these 3 specific metrics creates a mechanical trap that limits the effectiveness of domestic economic policy. The pressure from the U.S. labor market contraction and rising yields transmits through the global financial network to specific international nodes. In Australia and New Zealand, the transmission channel is the housing market, where variable rate mortgages are the dominant structure. Like the Fed, the Reserve Bank of Australia faces rising costs for oil and imported goods, which limits their ability to cut rates as their domestic labor markets soften. Because of the variable rate structure, any decision to hold rates high to fight inflation has a 3 times faster impact on household spending than in fixed-rate economies. This exports a liquidity crush directly to households, as debt servicing costs remain high despite the economic slowdown. A second vector connects the U.S. data shock to the United Kingdom. The UK is structurally dependent on imported energy, and the spike in crude oil arrives while domestic gas storage is below seasonal norms. UK households will see a faster and larger percentage increase in energy costs compared to US households. This energy spike halts the Bank of England's planned rate-cutting cycle, even as the UK labor market shows signs of softening. If bond markets begin pricing a stagflationary premium into UK sovereign risk, it will place downward pressure on sterling and upward pressure on gilt yields. The final contagion vector terminates in Switzerland. During periods of geopolitical escalation and market volatility, capital flows into the Swiss franc as a safe haven currency. The 142,000 job miss in the US, combined with the conflict in the Strait of Hormuz, drives a rapid appreciation of the franc. This appreciation creates a domestic threat, as the export sector accounts for roughly 70%. In a stagflationary cycle, the Fed's ability to intervene is restricted by inflation. This means credit spreads widening under both inflationary and recessionary pressure tend to be more persistent. Investors seeking confirmation of the economic slowdown now have a payroll figure that fell outside the lower bound of every institutional forecast. Every 50 basis points of widening above the current 3.0% level marks a material deterioration in credit conditions. Because of this persistence, the timeline for credit spreads to hit 5.0% OAS, the option-adjusted spread that signals a systemic credit event, is now measured in weeks. The framework identifies specific data triggers that will dictate the next formal reclassification of the fragility score. If the unemployment rate reaches 5.0%, EFI 6 moves to amber. This would raise the overall fragility score to approximately 47.6. At the current trajectory, this 5.0% threshold is reachable within 1 to 3 months. In a scenario of prolonged conflict, an unemployment rate of 8.0% would add a third red indicator to the framework, pushing the score to a critical 53.7. There is also a risk of veto 2, a condition where the Fed attempts an emergency rate cut while inflation is high, potentially driving the VIX above 35 and 10-year yields above 5.5% simultaneously. The current data confirms that the U.S. economy has entered the Phase 1 stagflationary equilibrium. With the Federal Reserve's policy tools constrained and credit spreads widening, the global financial system is moving toward a Phase 2 credit crisis.